Does Wall Street's rally have further momentum as we head into 2025? Welcome to Market Insight. I'm Peter Devlin. US stocks have surged over 50% since the start of 2023, lifted by a frenzy surrounding AI developments, a surprisingly resilient economy, and interest rate cuts. But can we continue to expect a bullish outlook as markets continue to digest the outlook from Donald Trump's presidential victory and as investors brace for the final earnings test this week? Well, joining me now to talk about all that is Satya Pradhuman, Director of Research at Cirrus Research. Welcome, Satya. Thanks very much for joining us. So let's start with the market as a whole. Strategists for Morgan Stanley expect the S&P 500 to end next year around the 6,500 level. That'd be up 11% from Friday's close. So do you have a bullish outlook heading into 2025?
Yeah, I think if that's an outlook for all of 25, I think that's more than reasonable. You've got an earnings backdrop that's basing. In other words, you've had this strong sort of pullback in earnings growth until about a year ago. It's stabilizing and the forward estimates look good. Importantly, the credit markets have been quite favorable. So we see credit spreads, that's the cost of funding for riskier firms. They're at 30-year low in the US. Importantly, they're also globally, these credit markets are converging to historically low US levels. This has been underway for over 6-9 months now. So we like that. Central banks are easing. And so that's generally a constructive thing. The one sort of fly in the ointment is this question of inflation. While I think we've really benefited from the sort of fall in inflation rates in the last year, markets are already up 25% as of this period. The question is whether or not the long bond or the 10-year treasuries will remain benign. So if you've got easy credit and globally central bankers are cutting rates with low unemployment rate, it's hard to see the 10-year behave. And that's important for market returns. If you have an adverse bond market, equity strategies will come under pressure. So we still see some noisiness. I think we still need to be active in how we select stocks. But overall, the backdrop is favorable for risk assets.
So another question for investors is Donald Trump's economic agenda. It may support sentiment further, but in your notes you did highlight financials are front and center. Can you explain why under a new administration?
Yeah, with every election comes a new administration and the forecast from Wall Street on markets. I think of all the various areas that will be impacted, the most clear is likely the financial sector. Part of it is that the fundamentals in the financial sector have started to heal in the past year. So irrespective of, sort of like the group that takes over, we think that was on a forward trajectory that was very favorable. That said, the regulatory backdrop for financials have been really, really aggressive. And if there's any success in cutting some of that red tape, it does make the banks quite a bit more profitable. So we foresee some of that. In addition, with really favorable credit markets, you're also like to see some added consolidation, some deal making. So the investment bankers, that component of the financial sector should do especially well.
As well, we look to big tech stocks. They have had a relatively muted reaction to Trump's victory as investors are considering tariff risks and a push towards deregulation. So could we see an end to the Magnificent Seven euphoria?
It'll be hard to say that sort of run, the interest in AI, stops on the administration's change. That said, you can have adverse events and regulatory events that surface that sort of cap some of the trajectory that we're seeing. That said, the spending on AI is fantastic, and it doesn't seem as if that's going to slow overnight. So markets tend to chase earnings. We think these companies are going to make money.
So let's keep with earnings as well. Nvidia coming up on Wednesday, analysts expecting a slower pace of growth. Estimates reflect the slowest growth in 6 quarters. What are the warning signs that you're looking for Nvidia?
Yeah, we've, as of the last quarter, their incredibly aggressive run rate on sales growth finally started to decelerate, but that's a number that's now like slowed to 190 something percent. So these are really fantastic numbers. I think, the law of averages suggests that number is on the slowing. That said, though, their ultimate customers are making a lot of money. So if the margins on the Oracles, the Metas of the world remain as strong as they are, it seems to me that the AI phenomena will continue, the demand for those chips will continue to run, and then the fallout to sub-industries should also benefit, such as like data centers, alternative energy.
So let's switch now to major retailers Walmart and Target. They're reporting this week as projections for the key holiday shopping season will be vital. So what are you expecting, and could weak results be a major hit to investor sentiment?
That's a great question. The consumer is a mixed bag. On the one hand, you've got really multi-decade low unemployment rates, and at the same time, the surge in the sort of like reopening of the global economy from the pandemic, the impact of those inflationary moves, they're still quite, relevant. And as a result, we believe that retailers, we've done some work on this that basically suggested you're going to bifurcate retailers where the price-sensitive consumer is here to stay. So as a result, both of those, Target, Walmart, both of them should continue to benefit as they have in this environment. So if you have a penny pinching consumer, the more discount, the lower end retailers probably work very well.
Satya Pradhuman of Cirrus Research. Thank you very much for your thoughts. And that's Market Insights. Don't forget, you can watch more videos on Reuters.com.